Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And what a fascinating art and science it is. Today, I'm going to be talking about positions I've taken out both in my derivatives trading book and also the portfolio that I manage on eToro. Everyone knows I've been very bullish on commodities for the better part of maybe 2 to 3 years now. And so it's come to the point where I've wanted to include them into the eToro portfolio. That was meant to be a very basic fund with low turnover and based on fundamental value investing. And if we look at the sugar trade as such, it is a fundamental value trade. It's just more based on macroeconomic environment. So today I'm going to talk about why I finally pulled the trigger in the fund for sugar futures and some of the risks and rewards that I believe might be on display. Okay, so from a macro top-down perspective, you guys, if you've been following the channel, know basically all commodities are experiencing tailwinds, and so with be it a supply dearth or a demand shock, we've seen almost every commodity that I can think of really shoot higher over the last, particularly 6 months or more. We're looking at a real lack of suppressed sustaining capex. So if you don't know what that means, the sustaining capex of a certain business is how much money the business needs to reinvest in order to continue doing their business. So for example, if you're an oil producer, how much per barrel of oil needs to be reinvested into new production, new wells, new leasing, and so on and so forth, so that next year you'll actually have some oil to sell. Okay, it might sound pretty basic, but every time you start to drill a finite resource, like let's say oil, for example, then you need to be able to, eventually that's going to run dry. So you need to be able to invest in new ways of getting oil, such as developing new wells, and that's generally referred to as capex. Low energy supply, high energy prices, high fertilizer prices, low crop yields, and a low supply of soft commodities, and remember their demand is relatively inelastic because we all need to eat, has set the perfect stage for a bull market, a raging bull market, I think it will be, in these soft commodities. We have seen fertilizer prices more than double over the last year. And so it stands to reason, and I've mentioned this for quite some time now, that we could be looking down the barrel of a really scary supply side picture when it comes to grains, wheats, and today we're talking about sugar. Exogenous supply, constrained factors like weather. Okay, now that obviously plays a huge part in terms of crop formation. Brazil's had some bad weather over this year and last year, so we're going to talk about how that might affect this particular commodity. And cost push inflation. So you've got supply being disrupted, so we have less of the commodity available. Then don't forget you can't just get sugar out of thin air by clicking your fingers. Someone has to produce it. You got to plant it, you got to grow it, you got to harvest it, transport it, refine it, all those sorts of things. And so that all requires labor, and labor prices, as we've seen, shooting through the roof because we've got a lower supply of available labor. In addition to the fact that inflation across the board needs labor prices to inflate alongside, so that every dollar you earn, it buys you the same amounts of goods and services or what you're used to, or at least your wages somewhat keep pace with what you buy, which is supposed to be represented by the CPI. Monetary expansion. So the M2 supply, we all know, has exploded. So we've seen 30% of all bills ever created were created in the last year when it comes to the United States. And so with all these extra currency units circling around, they're finding their places where you'll have a supply dearth, okay, because the demand will be higher than the available supply, and so those prices will get bid up. On top of that, we've got all this extra tinder sitting waiting in the wings to be able to move into those areas. I mean, it'll just be like a wash of liquidity. And where will it go first? It will go to necessities, i.e. commodities, and it will go to where there's a mismatch between the supply and demand, particularly where the demand is relatively inelastic and where the supply is both finite and in scarce supply, which will take quite a long time to come back online. Okay, so why sugar? Sugar is not a supply, not a commodity whose supply will take forever to come online. So you get 2 crops, I believe, every year with most sugar plantations, whereas it takes you maybe 10 years to build out a copper mine. Okay, but sugar has not yet run like grains and corn. We're going to look at some supply and demand for sugar. We're going to look at some factors that are peculiar to the sugar market, such as what I call the ethanol wild card, as well as the fact that government subsidies are rife within the sugar industry, and that will form, I believe, the main risk to our trade. And we'll talk a little bit about Brazil, because Brazil produces most of the world's sugar. Fairly straightforward. Okay, here's a look over the last year. So this is 1 year's worth of sugar quoted in cents per pound. These are the futures front month rolling forwards. If you look at, okay, well, what does that mean in context with all the other soft commodities? So here we've got wheat, corn, soybeans, and sugar. This is represented by the rolling ETF that TEUCRM put out. And I've spoken about this last year when I did the grain trade video. And we were talking about bull calls or exposure to wheat or corn, and they paid off very, very handsomely. My only complaint with those is that I couldn't buy enough of them. I tried to, and I unfortunately couldn't quite get the exposure that I wanted. But if you see the delta between, yes, sugar has run up, there's no doubt about it, but cane and bean are a long way below corn and wheat prices there. And so I think that in terms of a speculation trade or investment, obviously we'd be looking for the commodity that is yet to run, all other things being equal. So this is over a 5-year period, and you can see that sugar's actually been underwater in the sense of the price has just been in the doldrums. Whereas you compare to wheat, soybeans, and corn, mainly due to their latest run-up, they have outperformed. So sugar is the odd man out in this situation, and obviously we want to buy our groceries when they're on sale, and same with our investments and speculation. Let's talk about supply quickly. So supply constraints are associated with droughts in central South Brazil. Now, this is on the Australian government website. I've pulled a few different pieces of information from different academic papers. Okay, and so Australia is actually quite bullish in terms of our exports for sugar. Valuations should increase this year because there's expected to be less competition. And with everything that's happened geopolitically recently, it'll be interesting to see how all that plays out. The IEA has warned that Russian oil output may decline by 3 million barrels per day in April. I think it'll be a lot more than that when push comes to shove, prompting the Brazilian cane mills to divert output into ethanol. And I've underlined that because that is what I'm talking about when it comes to the ethanol wildcard. So oil prices are going through the roof. The oil supply cannot come back online as quickly as people think. We are going to be in for one hell of a rude shock when it comes to oil and gas prices. People will start screaming around the world, and voters will be putting pressure on their local legislators in order to do something, in inverted commas. And so they will start, and you've already seen Biden knocking on the doors of Venezuela and Iran and some of the other major oil producers to try and get more output happening. They don't want a bar of it. And so I think that Brazil will really be in a good position to be able to export more of their oil. However, this will have an interesting ripple effect. So we've got Brazil benefiting geopolitically because they're still relatively sane in terms of who they've got running the country. They have been in a three-man race, and one of the leading runners has just dropped out, that being Russia, of course. And so they're going to get a heap more business thanks to Russia being persona non grata. And so what happens in Brazil, there's a certain amount of the sugar production is mandatorily required to be converted into ethanol, okay? And this keeps the fuel and energy prices down in Brazil. So if you've got less available oil to be put into gasoline, I would expect there will be more of the sugar production converted over into ethanol. So we've got this ripple effect where there's oil price going up, Brazil will want to export more oil, and so you're going to make as much money out of that oil trade as you can if you're the Brazilians. And so you say, well, we've got heaps of sugar. Let's convert more of what we would normally export for sugar and turn that into ethanol. We'll use that as energy domestically, and we'll export a heap of our oil exports. And that is, of course, going to have the effect of reducing the sugar supply. We've got to reduce sugar supply, demand will be fairly inelastic, and so the prices I expect to rise. Shortages in Russia have also pushed prices upwards after surging food inflation led citizens to hoard non-perishable products. Interesting behavioral response, prompting Moscow to ban sugar export until September. So again, this just takes a whole heap of available sugar produce off the export market, so further reducing the supply. Shipping data has indicated at least 5 vessels carrying nearly 200,000 tons of raw sugar making their way to Russia from Brazil, about double the amount of annual imports by Russia. So the Russians are stocking the pantry, okay, and Brazil is gladly supplying, but guess what's happening to the local supply of sugar? That is continually being eaten up. The Australian government see a potential drop in production should the economic recovery be slower than expected, and we've got a drop in production. Again, that's less supply available on the market. Okay, so let's have a look at the inventories. Okay, here you've got the beets on the right and the cane on the left. And so obviously that's heading towards scraping the barrel territory. What are the key prices we need to look for? So cost of production, not an easy one to look at in the sugar market because subsidies play a huge role. It's not a free market at all. And that is my one concern when it comes to the sugar trade is the ability of governments to mess us up. Cost of production, according to academic papers that I've cited here, anywhere from 48 to 121 cents per pound. They quoted it in dollars per kilo when I converted it. When you look at the subsidies, look how much of a difference it makes. So Indian subsidies for their fixed and variable costs around 19 cents per pound. Okay, so this is a way that they artificially keep the cost of sugar production low so that their industry is protected. Okay, it doesn't do them any favors in the long run, but anyway, that's a subject for another day. Incentive cost, very difficult to work out. It doesn't matter so much with this because every year you can plant a new crop if you wish. All-time high for sugar actually reached 65 cents per pound, and that is an astronomical price for sugar in 1974. So remember, these are in much harder dollars, 70% higher than today's price before adjusting for inflation. So I'm not sure what that will be. You can plug that into an online calculator to work out today's equivalent adjusting for inflation, but we don't really need to. If we know we've got 70% room to move on the trade, we're interested. We know that the price currently, as I'm recording, I just checked, about 18 cents per pound, and so we're trading below the cost of production. Input cost curve, so you've got 21% is fixed costs, so no matter what, that's going to be fixed, and the producers are hoping they get to make all their money on the really good years. Variable cost of production, this is interesting. So 2/3 of the costs going into being able to produce the sugar is variable. And if you have that cost push inflation that I mentioned before, think about cost of labor. If you have to pay your workers a hell of a lot more just to get the sugar onto the truck, then you've got to pay more to drive the truck from point A to point B, and all that different points of transport, that's going to start to eat into your margin. And so we would then expect the incentive cost to have to rise for producers to feel like it's worthwhile for them to bother planting their sugar. Target price, trading economics, and myself. Okay, so estimate roughly a bit over 20 cents per pound, stretching out to 22 cents per pound if you look out to 24 and 25. So what does that mean? Let's take a look. Here's our broad range of expectations. So if we could get into the high 21s, high 22 cents per pound, we'd be absolutely laughing by the end of next year. ROI projections. So this is one where I will be using leverage, okay, in the eToro fund. So cents are what we're quoting, and we're talking contracts for difference. So 2084 is our target price. 1918 is the price, our average price of entry. Okay, so if we work out the profit margin there, should that trade be successful, you're looking at about 8.7%. And I'll be using some leverage there to gear up the return to 43%. Now that's basically a year from here. So our IRR would be, I'm hoping and expecting to be somewhere in the vicinity of 43%, which is obviously very, very good. So the verdict, as you can tell, I am long the commodity. We will be looking at anywhere from 1% to 3% assets under management. We're currently sitting at 3% of the book. Okay, I have a stop loss in place, and because it's a leveraged product and it's a commodity, so there's always variability involved. But I would expect if we start to really see this run on the way that I do think, I'll cut the position by 2/3 and see what else is happening at that point in time. Thank you for watching. If you enjoyed the presentation, by all means, please like and subscribe to the channel. If you're interested in a value fund that has a manager with experience in the commodities and is looking to do value trades, then by all means, jump on eToro and have a look at the portfolio. You can add us to a watch list, or you can copy with your own funds and mirror the performance of the portfolio should you wish. And disclaimer, of course, I'm not your financial advisor. None of this is advice, okay? This is just me putting out my opinions and sharing what I'm doing because I really enjoy this as a creative outlet. Please understand I could be wrong, okay? Not everything always goes to plan. There's always risk with investing. And so please understand this is just what I think, my opinion, and what I'm doing with my money and the money that I'm responsible for. Just because it's something that I think is appropriate for me does not mean it's appropriate for you. And so please always do your due diligence and make sure you take responsibility for your own investment decisions. Having said that, I hope you got a lot out of the video and I hope you enjoyed it. And I look forward to seeing you in the next